Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today, well, it's the man himself, Mr. Michael Becker. Michael, how are you?
A little cold, a little tired. How are you, Paul?
I'm doing okay. We're just kind of kicking off the first part of the year, and we'll talk a little bit about what we're seeing in the market too. But of course, joining us, the professor himself, Mr. James Eng. James, how are you?
Good. Thanks for having me, Paul. Well rested here.
Well, there's always a story, and then we'll get into the stories. So today, we're going to talk a little bit about, it's the first couple of weeks of the new year, 2026. And then most of us head out over to Las Vegas for the National Multifamily Housing Council meeting in Las Vegas. It was on between January 27th through the 29th. It's kind of the kickoff in the apartment investing and ownership and lender meeting. So the purpose of this meeting is to connect developers, investors, and finance professionals to discuss trends and the technologies and possibly any policy changes that we're seeing, or just the investment outlook for apartments. So it connects between 10 to 12,000 apartment investors, and it's usually a temperature gauge on what the rest of the year is going to look like. So you go there with expectations that everything's going to be great for the rest of the year, and sometimes the last couple of years it's been muffled. And so we're going to talk a little bit about what we saw out there and our journey to get out there. Mike and I were actually out in Las Vegas, and I think there's probably a bigger story that people were talking about if they were coming from Dallas, is how actually people got out to Vegas because flying from Dallas to Las Vegas last Sunday on American Airlines was a total fiasco. It was delay, then cancellation, not once for me, but twice. And then we held a mini National Multifamily Housing Council meeting for all the people that were delayed trying to get on that flight at the airport at the California Pizza Kitchen for 8 or 9 hours. So we had a bunch of folks from the industry, and we all chatted about what we were seeing in the Class B and C multifamily market. I'm going to talk a little bit about that. But Michael, you went out there early. James, you tried. Michael, tell me about the give and take about you actually getting, because that's half the discussions we had. How the hell did you get out there?
Yeah, that's right. Yeah, it wasn't just Dallas as a whole. Basically, eastern half of the country was under some sort of storm, and then I'm sure most people are aware, and the flights were just an absolute mess. So I was visit my elderly aunt in Phoenix on the Friday before, and come home and go back on Sunday, and I pivoted and just left from Phoenix to Vegas, and so I had 5 nights, which is at least 3 nights too many for Las Vegas, but I wasn't alone. There was, a little crew that showed up Friday, and then, we watched some games on Saturday and Sunday, the NFL stuff and the UFC fight, and, just kind of drug on and on and on. That was the whole thing, is like who's getting in, who's getting out. It seemed like real random and a crapshoot on which flights made it and which ones didn't. But yeah, you're right. That was a lot of the conversation that we had, and so probably muted the attendance a little bit, like James didn't make it out. So probably, took 15-20% of the people out that just didn't make it out, or delayed them in for sure, and had a couple of meetings canceled that we had scheduled. So it was the logistics were quite a challenge this year.
Well, you made it, Michael, because you went there a couple of days earlier. Again, it starts on Monday. You went on a Friday, and then ice storm hit Dallas and the rest of the United States. It was a complete fiasco. James, tell me a little bit about your story, because that's half the fun.
Yeah, so I had a flight 11 a.m. from DFW to Vegas on Monday morning, and they canceled that very early, which was nice. And then they put me on a DFW to Los Angeles to Vegas at 2:30 on Monday, and they decided to cancel the Los Angeles to Las Vegas flight when I got to the airport. And so I looked around, and there was a 4 o'clock DFW to Las Vegas, so I hopped on that. and they decided to play the delay game. And we had two pilots sitting on the plane and one stewardess. So we needed three more flight attendants to make it. And every 30 minutes, they said, they're almost here. They're almost here, guys. And then it was 11 o'clock, and they decided to cancel that flight. So I got to take an Uber back home at 11:30 on Monday night. And that was probably the worst Uber ride back home from the airport because it was completely iced over and it was probably 5 degrees outside. And this Uber driver was making maneuvers like it was like Gran Turismo out there or Formula One to avoid Dallas drivers who nobody should be on the road. No one should have been on the road at that time. But some of these turns where it's an undivided lane, so divided lanes were fine. So like the highways were fine. The undivided lanes in the suburbs where one guy's coming down and you're trying to, yeah, those were, you could not brake and people were skidding all over the place. But luckily we made it back, and luckily I did not check my bag. So a colleague of ours checked their bag on that flight, and that bag is still yet to be seen.
Oh boy. Oh boy. Well, I mean, I went to the airport twice from my house, which is only 10 minutes away from DFW airport. And so I probably paid, back and forth a couple times, $550, $600 in Uber fees to do it. So I actually paid more to go 10 miles than it cost me to fly 1,000 miles on American, and American never even came through. I couldn't get out, so I had to go out to Southwest and took a later flight on Monday. But they got me there to Las Vegas with a sightseeing visit to Omaha for 20 minutes, but I got out to Vegas. But the first time that I was at the airport, again, we were sitting around the California Pizza Kitchen. We're just talking to everybody. There's, if you can imagine, just a regular Los Angeles flight, got half of those knuckleheads that are just going out there to gamble and see shows. And the rest of them half of them were apartment industry concentric folks that really are kind of stewards of the industry and really knowing what's going on. So we all came together and we kind of had a little bit of a discussion over barbecue chicken pizza. So one of the takeaways from the discussion with the Dallas apartment leaders that were the investors, the investment salespeople, the lenders, is that the bottom of the market is either here or we are very close to being at the bottom. And that was even before we arrived in Las Vegas, that we were getting some of that good information coming from the investment salespeople, from some of the lenders of what they're seeing out there. And so a couple of things that came out of that one conversation at the airport before we even got out to Las Vegas was maybe 4 or 5 different points. And one of them, whether you agree with me or not, is apartment occupancy right now is pretty stable with certain amount of concessions in the market, whether it's a brand new property that you have to give X amount of concessions to the marketplace itself. And sometimes we heard last time James's sister had got 10, 11 weeks. Now they're probably going out 12 or 13 weeks for concessions in some of these Class A lease-up apartment buildings in the North Dallas-Fort Worth area, all due to concessions. And then 2, rents are fairly stable in the B and possibly C market. They're not spiking up. The renewals are pretty flat or even down, but they're still pretty stable. 3, interest rates are coming down. The long-term treasuries are pretty flat. They're trading between, say, 4.5 probably is the speculation in the marketplace on these longer-term 10-year treasuries. And then the short-term rates, whether SOFR or other shorter-term indexes, those are falling and have been falling for last year. Number 4, underwriting has reset, and then pricing/values have come down significantly. And number 5, and I think this is where we're going with this, is that finally time has passed from the 21-22, where valuations were high in the market, and now capitulation is here. So one of the top investment sales brokers in Dallas was in that discussion over that chicken pizza. And he told a story about what he had recently seen, which I thought was interesting, and what I wanted to share with you guys is that he completed on a 2-property apartment portfolio a BOV that the lender had taken back from a very aggressive apartment syndicator a few years ago. The syndicator/borrower bought the property on a bridge loan, and a few months ago, that syndicator was out of money, and the lender foreclosed upon the property. Well, what happens when a lender owns the property? They typically need to sell the property, pay off the loan, put it in somebody else's hands. In this case, the lender was out shopping real estate brokers to have them take it to the market. So they're looking for some BOV. So they pushed the assignment over to two guys that, and one of the guys I was chatting with was one of the two guys, and with another high producing broker here in Dallas to create a BOV, again, a broker's opinion of value. Both created the BOVs. And this is where it gets interesting, at least I thought it was, is that the other broker, and he got the listing, not the guy I was talking to, the winning broker, he assigned a BOV value at $70,000 a door on a class, say B minus C plus C property in Dallas. But when he was talking to so he won the deal, but when he was, what my broker was telling me was that when he was listening and talking to some of the buyers that had put their hand up to try to buy the property, that broker was actually guiding people to say $65,000 a door, not $70,000 that he was telling the lender, but $65,000 a door, according to the buyers that were competing. And then the broker that I was speaking with, that he had assigned a value of $54,000 a door. So you go from 70 to say 65 in the market guidance. And now the broker that lost the deal, he was guiding me saying, really, that deal is not going to sell unless you got $54,000 a door. That's where the market's at, or where the market's going. So just like in gambling or Las Vegas, at the tables, you can certainly see a tell. Sometimes, Michael, you play a lot of poker. I think that's a capitulation in the market. And I think that's telling us is that, that's a big step for, let's say, $110,000 to $140,000 a door back just a year ago or 2 years ago to being at 70, 65, and now $54,000 a door that some brokers are thinking that property's worth today. And again, this is a top broker that's telling me this information. So James or Michael, what's your take about the capitulation of the market? Is it here now? Is it coming? Where is it?
Yeah, no, it seems like it for the class C stuff in particular, and then maybe kind of market dependent, and then B somewhere in the middle. But yeah, I think the older class C stuff, you're certainly seeing lenders kind of the end of the rope, borrowers in the rope, and they're ready to go. And you've seen these kind of enough marks, I think, set over 2025. Enough marks have been set where the values are kind of reset, and the marketplace believes that's where the values are, and then they're willing to go ahead and clear it. So I think we see even more and more marks set this year. So probably has a somewhere between 12 and 24 month kind of clearing process. I don't know if we get all these deals kind of worked out through 2026, but I think we get a whole lot of them worked out in 2026, and then maybe the first half of 27, and we start kind of seeing improvements, which is good. We need all these deals to stop being zombie deals and start trading. That's my 2 cents. James, anything to add?
Yeah, I mean, it'll be interesting to see if the offers come in at 50 a door on your deal, Paul, is the lender going to take that trade or not, right? Because their basis is probably 75 a door. When they made the loan, they probably thought 75 a door, that's plenty of cushion. But now, a lot of people have been putting out who's going to buy these deals, because it's 75 a door on a 100-unit deal maybe can happen, but 75 a door on 300 units, I guess who the buyer is for that has shrunken significantly. So I think that's where the nuance is that there's a lot of people like that we work with that have, can raise $3 to $5 million and go buy a $10 to $15 million deal, no problem. It's the probably $25, $30 million deals that are more challenging in the BNZ space right now.
No, absolutely. I mean, you look to your right, you look to your left. Last 3 years ago, you could raise $20 million and there would be a line of people wanting to put $20 million into a $50, $60 million property. Now, there's only a few people that can put money into these deals. And I think that's the reason why these values have come down, is because there hasn't been a bottom for a long time, but I'm starting to feel that bottom right now in these class, say B minus C and C plus properties that we're coming to it. But the numbers have to make sense to generate interest on a per price, per unit, per pound basis. That now it's at $45,000 or $50,000 a door. Now that attracts my interest. I can start thinking I can probably raise maybe $6,000, $7,000, $8,000, $10,000 or $10 million to do a deal. So I think the capitulation is starting to show in that space. And I think that maybe that's where the buying opportunity that should not be missed for folks to get into this marketplace itself. So, Michael, you were out there, you were talking and chasing equity people and lenders and brokers. Tell me a little bit about your experience there.
Yeah, no, I think two main takeaways. One, I think the debt market's starting to get quite a bit more competitive. Still a little tale of two cities, so the better quality, better located, down the fairway, 2000s and newer, better locations. Those are extremely competitive. And then the bigger to smaller, older, or the bigger, older deals or guys James alluded to are a little tougher. But even there's more and more abundance of capital. So it seems like all these debt funds have raised money thinking that they can go put a bunch of loans out. You have the agencies are still pretty tight on their spreads. And you have the banks are back. So the banks are, looking to put a bunch of money out. And there's just not many construction deals right now that make sense. Seems like the debt is pretty available, on reasonably conservative terms, but the equity isn't there for new development and scale at least. So they're having to go chase some existing product and things like that. So it's kind of a race to the bottom on loan spreads right now, which is great. So, if you had a debt fund deal 12 months ago, you might be getting quotes between 3 and 4% spread and maybe 325, 350, something like that. And now, it's probably more like 250, maybe less on a spread with the debt fund. And then these banks, I mean, for the bigger, better deals, better borrowers, I mean, you're seeing 150, 175 spreads, at least I am quoted, which is great. I mean, that's pretty damn tight. So, you get your index is SOFR, and then there's your floater rate. The index is SOFR, then you get above that. The agencies are also pretty tight. I think they're, obviously a little cautious in certain markets and submarkets and vintages and things like that. But, they're out there and they're abundantly, have abundance of capital. So that's good. So I think that's kind of firming the cap rates up. I think cap rates really blown out too much, but certainly supportive of that. So the debt's here. So I think, the worst of the worst will probably mute. You hear these wave of maturities coming up in 26, 27, 28. I was reflecting back, Paul, to a meeting you used to host bankers meetings back when I was a banker over a decade ago. We'd go to the Park Cities Club, and you had back in the GFC, maybe 2011, something like that, 2010, the wall of maturities was coming up then, and just really wasn't as bad as they thought because there was just all these lenders that had an abundance of capital that really kind of muted it. It's not like it's going to be, if there's 10 billion in maturities, it's not like it's all going to have a problem. It's only going to be a percentage of that with rates coming in, spreads coming in. That'll take the edge off of those issues on your better quality deals. The other takeaway I had an equity partner that been kind of, we've been talking to for a while, and they just did their first multi-deal in 3 years. He was telling me the story, how they did it, and it was kind of like checked every box, and it was like, cream of the crop. So it was kind of the center of the bullseye for what they were looking for. And he kind of made a comment. It's like, it's funny how we're kind of at the bottom of the market, and we only, we're so disciplined, and we do only it's going to check every single box for us to get going. And at the late part of the cycle, we get real loose with our criteria, and when the values move up 40%, and that's when we're getting loose and trying to throw money at almost anything. So I think that's kind of it. You're going to kind of part of the story though that you and James are just talking about, that the bigger deal, the worse location, the physical characteristics, that's tough. Those deals are going to have to get cleared at a substantially lower price than something that's kind of, 5 years old, 10 years old, newer, occupied well, and don't have a bunch of bad debt and things like that. So it's going to be very bifurcated market. So I think there's money to be made up and down the spectrum, but those are certainly gravity set in the market, and there's a disparity. It's disparate between the top of the grade and the bottom of the grade, and that those prices can be crystallized. So those are kind of my two main takeaways.
James, unfortunately, you were not able to make it out to Las Vegas, but you were on a conference call with the chief economist for Yardi Matrix. Any comments on that or thoughts?
Yeah, the whole 30 minutes I was scribbling notes because I wasn't standing in front of them like you guys were. So I took some notes here. So I reached out to this guy in October and said, hey, I want to meet you in Vegas again. We had met him last year, and he gets to see all whatever thousands or millions of units that Yardy tracks. So I wrote a couple notes. One of his first comments was just around embracing reality that this is going to be a little bit of a slog. So just the number of completions that hit the last 2 years, it's going to take a while for some of these rents, especially in the Sun Belt, to come back. So, he had his rent forecast, and there was really only maybe the coastal markets and maybe some of the Midwest markets where they're seeing rent growth this year. And then a lot of it is still negative rent growth this year. And then really 27, 28 is when you're going to see positive rent growth. And we only had a couple questions for him. And one of my questions was, when's the bottom? And he's like, when these rents turn. So, whether you talk to current owners or even new owners or new guys trying to get into the business, they're like, well, what do I underwrite for rent growth in year one? Negative 3%. Like that just doesn't feel that good. Sure. Year one, right? So why don't I just wait till next year then and then step into the market, right? So I think that's a little bit of the challenge for the underwriting piece right now is, okay, if I underwrite negative rent growth for a year, and then do I make that up in the back half of, year 2, 3, 4 on these deals? So, but overall, I mean, I think it still has got a little bit of ways to go, I think, from his perspective. But I think my other thing that, Mike touched on is really around, like, in 21 and 22, the number, it felt like January 21, that is when the number of bridge lenders who came into the market that you had never heard of all of a sudden showed up. And that was driving pricing so low. I think it's a little bit the same this year, except all those debt funds and all those bridge lenders are looking for recaps. So they're not looking for acquisitions necessarily. They're all looking for recaps of deals. So construction loans coming off, construction loans plus pref, all that stuff. There's a lot of just sort of stretched senior money out there. And a lot of that new money is guys you've never heard of. And so I think that's a little bit of the race to the bottom in terms of pricing.
The backfilling new development, right? And trying to take
Yeah. So the new development guys, they're like, look, I don't want to sell right now into this market and basically lose all my equity. And these new bridge lenders are coming in and saying, look, we'll give you 85% LTV and SOFR plus 250 on this new deal. And that's going to prevent that guy from selling right now. That's just, that.
And anecdotally, we were chasing a portfolio last year from a very large developer, and their pricing was aspirational. And I was like, this is just, insane. I was talking with the lady over there, and she's like, well, we're getting MF1, this bridge lender, which did a whole bunch of terrible deals back at the peak. He's like, they're stretching, and it's just more accretive. So they'll give us a 311 at whatever price, and so it's just more accretive, and we're just going to kick the can down the road. Now, the developer, I don't know if they make any more money because their promote's going to get buried with the pref, but it's better for the equity to kind of hold out, not crystallize the loss. So that's definitely an anecdotal story that they did. They had that 55 deals or something in Texas they had to clear at some point, so they refinanced the whole slug of them.
Yeah, it's a little bit different out there, buying distressed capital stack versus recapitalizing existing owners. So, attempting to recapitalize existing properties from a distressed sponsor is kind of a fool's errand, I would probably imagine, kind of a full stop. There is no room in these capital stacks without a write down of the senior debt, and that's not happening. And there's little alignment between the existing owners and the new capital from a decision standpoint. So the value is just not there. So maybe the 26, 27 play is acquiring properties with distressed capital stacks from enforcing sellers. And that can come from lenders pushing a sale. So we've seen that from some of our DUS lenders pushing a sale, to existing equity pushing a sale to recover a portion of their equity. So if they can't get it, 100 cents on the dollar, they'll settle for 20 cents on the dollar if possible. Just something. Or the potential buyers falling out of contract because they can't raise equity on these deals. And the 4 sponsors who fought the market for 2-3 years and now have capitulated and decided to move on. When you're talking to some of these folks, Michael, out there, I mean, what was some of the take from, say, some of the lenders? I can tell you, I talked with a lender that we've done a lot of business with in the past, and they've been taking the approach on their bridge loans is substituting the sponsorship, the guarantor, and bringing in a new sponsor that it maybe has a track record history in another location, but it maybe has some additional liquidity. And instead of offering them a bridge loan at 80%, they'll just have them assume the current loan, and that would probably get up to 90, possibly 95% with unbelievable artificial terms that would give them flat fixed rates that are really non-market type fixed rates. Then that's how they're trying to solve their problems, just substitution of the sponsorship.
That's been going on for a couple of years, and we haven't played in that space, Paul. But I think it's a great choice for the lender, because then they get someone to put some money in, manage their asset for them, and kick the can 3 years, versus having to take an REO on and do it themselves. And so I'm unsure if the sponsor is going to make any. They might just be working for free for 3 years, and then the lender's like, okay, well that's over, and market's better now. It's time to clear. So it seems like they're just kind of running a sponsor for a few years, and sponsor may not lose a whole lot of money, but I don't think they're going to make any money, and so the opportunity cost might be kind of great. That was a big takeaway. The other thing, not that we take prep, but like seems like the last in 24 was like the constant theme, and probably the first half of 25 we're trying to find a larger equity check. So you talk to a million different people, probably literally 100 groups. And everyone is like, have common equity, pref equity, and then you pitch them a deal, and they're like, oh, I'll give you pref. Like, they're not interested in common, I'll give you pref. And that's been and then we're like, no. And then you go to the next one, and next one. And those pref terms were 15 to 18%, kind of maybe something less current pay. And those are now like coming down to like, 12%. So they're starting to they aren't like 9% like they were at the peak, but they're not, so they're about halfway back. Seems like they're not, all these guys raised all this money with the expectations of a certain level of returns, and then just not the volume of it for all these various reasons. So they're all starting to like drop their price to try to get the money out. So cost of capital is getting cheaper on the debt, cost of capital is getting cheaper on the equity. So I think we're going to start seeing people like transact. And, you can't not do nothing forever. So, you haven't done anything for 3 years. You got to start, putting loans and money out. I had one of the larger kind of regional banks that we bank with. They're certainly courting us right now to try to get more money out the door. And, I remember having a conversation with him in 22. We had 4 bridge loans out, and I was like, all right, he told me how to kind of pay him off. I was like, I'll pay you off. And then a couple of years from now, you come back on the apology tour with all the people you told to pay off when all your loans are gone and you need these loans. And sure enough, that happened last year, and kind of going there now. So I think we're just in the price. It's in flux. There's a lot of moving parts, a lot of uncertainty. Is very disparate by property type, age, submarket, et cetera. But there's just a lot of opportunity. So I think just kind of sifting through all that, there's definitely going to be a lot of money to be made here with the the near-term vintage buys. I think will age really, really well. And with that negative 3% rent growth that Yardi Matrix is forecasting to James, I mean, it kind of puts some people on pause, and those that, wants to kind of see the negative 3 go to positive 1.5 or 2 or whatever. I think the pricing gaps up quite a bit as investors kind of flood in with the all clear sign. I think that's the last thing that we need to see, Paul, to flash all clear is a positive number on the rent growth. It doesn't have to be 10%, it could be 1%. And I think everyone kind of comes in. That's the last thing I think we need before we see, full recovery. So it kind of seemed like a mixed bag of sentiment. That was the other thing I didn't say that I had to take away. So some people were positive, and people are positive about the buys, but they're kind of just negative about near-term fundamentals from, occupancy, rent growth, things like that. So it's kind of like it's definitely mixed from a sentiment standpoint. Lots of green shoots and still like a lot of negativity, kind of depending on who you're talking to.
How many bodies they have buried, that determines their negativity.
And I'm talking to people in the Sun Belt. I'm not talking to people that are in Chicago or someplace with San Francisco with zero supply, and they've already taken their pain before. Now they're on the backside. All these people, all this conversation is probably a Sun Belt slant to it as well.
Yeah, I think the Yardi economist also brought up just sort of the political risk in some of these areas. I mean, we didn't get into it too much, but just these national players are starting to look at, whether it's New York or Chicago or Minnesota or California, just the political risk that being in some of these markets is going to have on you. This is a soft plug for our bus tour, but the bus tour we had in January, in all those markets, those people are not investing in those markets and they're coming here. So Dallas is still, I think, the number one market, whether you look at ULI or whatever report in terms of number of deals that are happening, and just people don't want that risk. I think the one change probably in the last year since Trump took over was really just around, these Sunbelt markets. There's just a lot more immigrants in these markets. That has added to the Class C pain a little bit here, more so than probably anybody expected.
Plug that bus tour one more time again, James. On the last bus tour, I would say 90% or so of the people were not from Dallas, Fort Worth.
Yeah, not from Texas. So California, New York, Chicago. Yeah, just from all over the place. And so the next one we're doing, it's going to be a little bit warmer, but not too warm for you folks up there. So it's the last Friday of March. So March 27th, we'll be doing our bus tour. We'll go see probably 3 or 4 properties that are on the market or that we recently financed here in DFW. So that's something to sign up for. If you're going to come to Dallas anyways, might as well make it that week. So just go to oldcapitalpodcast.com and you can register there.
I think that's a great thing to come and see. And there's nothing like walking a multifamily property and walking through it and smelling what's going on, and just seeing the dynamics that go on with multifamily properties and the possibilities of making money in that asset class. And we've been talking about that for the last 30 years or so. Michael, last thoughts before we say goodbye to the National Multifamily Housing Council meeting for 2026?
Oh yeah, I think it was a little long and tedious for me personally, just being out there 5 days. But no, it was good. I think they're starting to see quite a bit of hopefully volume pick up. I mean, I don't know if we're going to get back to 22 levels here, 21 levels, but maybe closer to that kind of that 2015 through 2019 normal. I bet you we're still probably a little south of that, kind of from a trade volume in DFW or in Texas in general. But yeah, I think as soon as we see rent growth prints, people are going to be bullish, and so I think that's just really the last thing. So until once that kind of comes in, I think we see pricing start to pick up at a much greater pace. So the opportunities now, and is disparate, and there's going to be a lot of money to be made on some of these buys here, and a lot of work to be had on these older deals too. No question about that. But I would encourage you guys, if you're newer or want to learn a little bit about Texas, to hop on a plane, come here, and go on that bus tour. That's a good first step for sure.
James, you had the final word. What's the final word and thoughts for somebody that's been doing this for a long period of time?
The guys who've been doing it for a long period of time, you know exactly what you need to do, and that's focus on your properties right now and maintain occupancy. That seems to be the fight every day. When I talk to owners, is just keeping above 90% seems to be the biggest struggle. So whatever you got to do to keep those people in. But for new people, I think new people are coming in, and unless they hear our history lesson on the bus tour, they don't realize where we've come and how far values have dropped just in the last couple of years. And as an entry point, this is probably a pretty good entry point for most people. I saw a post recently that, even listing brokers are focused on new blood into this market, because a lot of the guys, class of 21 and 22, just are gone. They're not here. So focusing on newer buyers, I think, is the focus a lot for 26.
And you think about it, the pound of stock market returns since 2022 is probably 70+%, and the S&P compounded,
yeah.
And it's these workforce housing values are off 35-40% or whatever, unlevered basis, and Class A may be off 20-25%. So on a relative basis, it's pretty stark compared to, say, where the public equities are from a relative valuation period basis over the last, say, 3 years. So that those of us kind of hearing that, I mean, it's on sale.
Maybe it's a rotation from the S&P 500 over to multifamily in Irving, Texas, or Richardson, Texas, or wherever, and take the opportunity for it to go up. So again, James and Professor Eng, thanks for spending some time with us today, giving us your perspective about what's going on. Michael Becker, always a pleasure. Thank you very much. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.